Thank you for watching. Please like and subscribe to our channel.
All right, welcome back to The Explainer. So this week, we're diving into a purely data-driven look at the technical setups for 5 absolute market movers heading into their highly anticipated mid-July earnings reports. We're pulling data generated for the week of June 29th through July 3rd, 2026, and we're going to be closely tracking market sentiment, analyst expectations, and those underlying technical indicators you absolutely need to be watching before these companies reveal their final numbers. Here is our roadmap for today. First up, welcome to earnings week. Second, the financial heavyweights. Third, the streaming wildcard. And finally, the technical takeaways. Section 1. Welcome to earnings week, establishing the baseline market mood. Now, what is really fascinating here is the incredible uniformity across the board. Look at this. We've got 4 massive banks reporting on July 14th and 15th, followed by a major streaming giant on the 16th. And despite totally different sectors, different business models, different reporting days, all 5 of these stocks are sitting firmly in a neutral sentiment band. They're all ranging in a score from a slightly cautious 45 to a slightly optimistic 55 out of 100. So what does this actually mean? Well, it tells us the market is basically holding its breath. There are literally no wild, overarching expectations baked in just yet. Investors are genuinely just waiting for the data to speak for itself. Section 2. The financial heavyweights, analyzing JPM, GS, BAC, and MS. Okay, just as a super quick refresher on the technical baseline we're tracking here, we're going to be watching for RSI levels, that's the relative strength index, which signals an oversold or undervalued state. And we're also looking at the simple moving average, or SMA, to help smooth out the noise and identify the actual price trends over a specific time frame. So even though these banks share that neutral sentiment we just talked about, their technical risk profiles are actually deeply divided. It's kind of like a tale of 2 risk levels. JPMorgan Chase and Bank of America, they're categorized as low risk with relatively stable volatility metrics at 23.9% and 21.4% respectively. But then you have Goldman Sachs. Goldman stands out with a medium risk profile and a significantly higher volatility rate of 31.9%. So, if you're watching these stocks, this higher volatility basically means Goldman is prone to much larger price swings leading into its July 14th report. Now, the absolutely crucial point for Bank of America lies right here in its RSI of 20.6. Since a normal RSI usually hovers between 30 and 70, a 20.6 uniquely triggers an RSI oversold indicator among our low-risk banking tier. According to the technicals, the market might have actually punished Bank of America a little too harshly ahead of earnings. It's like the stock was put in a penalty box it didn't fully deserve. But, despite the varying volatility and those RSI triggers, there is a shared, pretty bearish technical trend connecting these 3 banking giants. JPMorgan Chase, Goldman Sachs, and Bank of America are all currently trending below their 50-day simple moving average. For the last 2 months, the momentum has just been definitively sluggish. They are walking into their earnings reports from a position of technical weakness, not strength. Pivoting over to Morgan Stanley for a second, there's a really unique data point we need to highlight regarding analyst predictions. While analyst earnings expectations for the other banks are actually currently showing as NA, Morgan Stanley uniquely shows a calculated trailing EPS of $11.04 alongside a price-to-earnings ratio of 20.21. For you as an investor, this provides a much clearer established valuation baseline on a massive $352 billion market cap, by the way, to measure against when those final numbers actually hit the wire. So, we've seen how the major banks are looking, right? Cautious, somewhat volatile, and largely below trend. But what about the entertainment sector? Does a completely different industry yield a completely different technical setup? Let's take a look. Section 3. The streaming wildcard, Netflix's technical setup. Okay, this is where the technicals get pretty extreme. Netflix's current RSI is 6.6. I mean, wow, if Bank of America's 20.6 was considered an oversold trigger, an astonishing 6.6 literally screams oversold far louder than anything else on our board. The technical indicators are effectively saying that the selling pressure on Netflix has been absolutely immense. Now, Netflix is tagged with a medium risk profile because structurally, it sits squarely in the middle of its 52-week high and low, specifically at the 49.7% mark. However, its volatility is sitting at 33.2%. That is the absolute highest of any company we're analyzing today. It's technically way oversold, it's sitting right in the middle of its yearly range, but it is highly volatile. Basically, Netflix is the true wild card of the week. Section 4. The technical takeaways. Synthesizing the data. So, despite wildly different industries, these 5 companies share some remarkable technical patterns. Number 1, all 5 stocks are trending below their 50-day simple moving average. The momentum is just suppressed across the board. Number 2, Bank of America and Netflix are aggressively flashing that RSI oversold signal. Number 3, volatility is really peaking in our medium risk stocks, Netflix and Goldman Sachs. And lastly, tying the whole shebang together, the overall market sentiment remains strictly neutral for every single one of them. So what does this all mean for us? Why does it matter? Well, because the technical reality tells a story of a cautious, below-trend market. Investors and analysts alike are just holding their breath. They're refusing to price in huge victories or massive defeats. The charts are effectively in a massive holding pattern, waiting entirely for these actual earnings numbers to come out and dictate the market's next significant move. Which leaves us with this final, burning question to ponder before the data drops. Are these suppressed, below-trend technicals, especially those extremely oversold RSI levels, priming these major stocks for a massive post-earnings bounce the second good news hits? Or are these indicators warning us of a deeper underlying correction that earnings will only accelerate? I guess we'll find out starting July 14th. Keep your eyes on the data, and we'll see you in the next explainer.